The financial world rarely behaves as randomly as most people assume. Beneath the surface of rising markets, falling markets, optimism, panic, and recovery, there is a repeating rhythm, a structural pattern that has quietly shaped economies for centuries. This pattern is the economic cycle. It is not a theory reserved for economists, nor a concept limited to academic books. It is the underlying current that determines when wealth is created, when fortunes are lost, when opportunities arise, and when danger is highest. Whether individuals recognize the pattern or not, they live inside it every single day. Most people experience the cycle without ever truly seeing it. They enter the market when enthusiasm is at its peak, convinced that prices can only rise. They panic when downturns arrive, believing that the darkest moment will last forever. They borrow aggressively during times of abundance and then collapse under the weight of debt when the economy contracts. This behavior is not ignorance alone. It is the natural human tendency to assume the present moment is permanent. But in economics, nothing is permanent except repetition. Every surge is followed by a slowdown, every expansion by a peak, every peak by a decline, and every decline eventually gives way to recovery. Those who understand this sequence, even at a basic level, place themselves in a position of long-term advantage. To understand cycles is to understand that economies breed. They expand, slow down, contract, and revive. No nation, no industry, and no individual escapes this pattern. Even the most powerful economies in history have been shaped, and repeatedly humbled, by these phases. The more you observe, the more you will notice that no event is truly unique. The circumstances change, but the underlying dynamics repeat with remarkable consistency. The cycle is not a prediction tool, nor a shortcut to instant wealth, but a lens that helps you interpret the world with clarity and avoid mistakes that trap the majority. When financial markets rise for many years in a row, people begin to believe that growth is natural and inevitable. They feel confident, sometimes overly confident, that the future will mirror the recent past. But growth is not a straight line, it is a wave. The same is true for recessions. When economies slow down, when layoffs rise, when stock markets fall, fear spreads rapidly. People come to think decline is endless. Yet historically, no recession has lasted forever. Every winter has eventually given way to spring. What separates the people who survive and even prosper in downturns from those who struggle is not superior intelligence but perspective, knowing which part of the cycle they're standing in. Consider the global financial crisis of 2008. To the majority, it came like a sudden storm. Housing prices collapsed, banks failed, stock markets erased years of gains, and unemployment surged. But to the minority who understood cycles, the downturn was not the end of the world. It was the beginning of an extraordinary opportunity. They knew that excessive lending, inflated asset prices, and unsustainable optimism were the classic symptoms of a late cycle peak. So when prices crashed, instead of panicking, they accumulated quality assets at historically low valuations. Several years later, when economies recovered, those assets multiplied in value, creating a new generation of millionaires. This pattern does not belong exclusively to 2008. History is filled with similar transitions. The dot-com bubble at the turn of the millennium, the oil crises of the 1970s, Japan's monumental rise and dramatic collapse in the 1980s, and even the disruptions triggered by the global pandemic, all fit into the broader rhythm of expansion, peak, contraction, and recovery. Each event looked unique on the surface but followed the same structural path underneath. Cycles are not merely macroeconomic phenomena. They influence the job market, real estate prices, business growth, consumer behavior, and government policy. When economies expand, companies hire aggressively, salaries increase, and borrowing becomes easier. Consumer optimism pushes spending to higher levels. Real estate prices rise as people feel secure enough to buy homes or invest in rental properties. Stocks rally because investors are confident about future profits. Yet these same factors eventually sow the seeds of overheating. When optimism peaks, risk-taking accelerates. People borrow more, invest recklessly, and assume the upward trend will last indefinitely. But every period of excessive optimism eventually encounters constraints. Inflation accelerates. the cost of living rises, and central banks respond with higher interest rates to cool the economy. These higher rates make borrowing more expensive, reducing business investment and slowing down consumer spending. Markets begin to wobble. At first, most people ignore the warning signs, believing they represent temporary noise. But once the cycle turns decisively into decline, the shift happens quickly. Recessions can feel sudden and overwhelming, but they are rarely random. They occur when the previous phase becomes stretched beyond sustainability. Businesses that expanded too aggressively face declining profits. Workers lose jobs as companies cut costs. Investors who bought assets at inflated prices watch them fall sharply. News headlines turn negative, fueling more fear. Yet even in these downturns, opportunities quietly accumulate. Prices fall below intrinsic value. Strong companies become temporarily cheap. Real estate in good locations becomes accessible again. But because fear is dominant, few people have the courage or perspective to take advantage. Recovery, the next phase, always begins subtly. It does not announce itself with loud optimism or immediate growth. Instead, it emerges gradually in the data: slightly lower interest rates, small improvements in employment, a shift in consumer sentiment, stabilization in corporate earnings. Early in the recovery, most people remain skeptical. They recall the pain of the downturn and avoid risk. But this early stage is often when the best opportunities appear. Those who can see beyond fear position themselves ahead of the crowd and benefit when confidence returns. The complete cycle, expansion, peak, recession, and recovery, repeats over and over because human behavior repeats. Optimism leads to risk-taking. Excessive risk leads to vulnerability. Vulnerability triggers decline, and decline eventually resets conditions for growth. The pattern is psychological as much as economic. This is why understanding cycles is essential. It teaches you to step back from emotional reactions and see the larger structure behind day-to-day noise. If you approach financial decisions without a cycle-based perspective, you will likely join the majority who buy at high prices, sell at low prices, borrow too much during booms, and panic during downturns. But when you recognize the stage you are in, you can adapt your actions. You become more cautious during peaks, more prepared during recessions, and more decisive during recoveries. You no longer move with the crowd, you move with the cycle. Understanding cycles does not require predicting exact dates. No one can perfectly time when a peak will occur or when a recession will bottom out. The goal is not prediction, it is interpretation. You observe interest rate trends, inflation data, credit conditions, business expansions, and shifts in investor sentiment. You look at how quickly people are borrowing, how aggressively companies are hiring, and how confidently consumers are spending. These clues help you identify whether conditions resemble early expansion, late expansion, early peak, or something closer to recession. With this awareness, every decision becomes sharper: when to save, when to invest, when to stay defensive, and when to position for growth. For individuals, the cycle affects nearly every aspect of financial life: career planning, saving habits, investment strategies, real estate decisions, and even business timing. Someone who understands cycles will not purchase property when credit is tightening, will not chase speculative assets during euphoric surges, and will not panic sell when markets drop. Instead, they prepare during good times and act during difficult times. As the saying goes, opportunities are rarely visible when the crowd is afraid. They only become obvious in hindsight, after the cycle has already moved on. To navigate the modern world intelligently, especially in an era of rapid technological shifts, geopolitical tensions, and global financial interconnectedness, understanding cycles is no longer optional. It is the foundation for long-term resilience. Whether you invest, run a business, or simply want to protect your savings, recognizing cycles reframes how you interpret headlines, market changes, and government policies. You stop reacting impulsively. You begin responding strategically. Economic cycles become easier to understand once you stop viewing them as isolated events and instead see them as consequences of accumulated pressures. Every shift in the economy, whether upward or downward, originates from small decisions made by millions of individuals, businesses, and governments. These decisions compound over time until they reshape the entire environment. When people spend more, businesses expand. When businesses expand, they hire more workers. When workers earn more, they spend more again. This positive feedback creates momentum. But as momentum builds, it can grow faster than the underlying fundamentals. That imbalance is where the next turn of the cycle begins. The root of almost every economic fluctuation is behavior, specifically, how humans respond to comfort, scarcity, optimism, and fear. These emotional states influence borrowing, investing, and consumption patterns. In periods of growth, confidence rises. People feel secure enough to take financial risks, such as buying homes, starting businesses, or investing in markets. This behavior accelerates expansion. Over time, the expansion becomes self-reinforcing, and the perception of stability increases. People begin to assume that growth is the default condition. They forget that expansion contains the seeds of its own reversal. When optimism overwhelms caution, borrowing rises more quickly than income. Debt becomes normalized. A person who previously hesitated to take a loan suddenly feels that everyone is doing it. Companies stretch themselves with aggressive projects, confident that demand will always be strong. Real estate developers build more homes than the population needs. Banks loosen lending standards. Governments reduce attention to fiscal discipline because tax revenues rise during expansion. These behaviors do not immediately cause problems. In fact, for a while, they create the illusion of prosperity. But the imbalance grows quietly beneath the surface. The slowdown begins long before it becomes obvious. It starts when rising costs make expansion harder to sustain. Wages increase because companies compete for a limited pool of workers. The cost of raw materials climbs as demand outpaces supply. Higher demand for goods pushes inflation upward. When inflation becomes too strong, it reduces purchasing power. Consumers begin to buy less. Businesses face shrinking profit margins. To control inflation, central banks raise interest rates. Higher interest rates affect nearly every aspect of economic life. Mortgages become more expensive. Business loans cost more, and investors reassess valuations. What once looked safe begins to look uncertain. This shift in sentiment is subtle. At first, people believe it is temporary. They view early warnings as noise. But financial conditions tighten quietly. Companies delay hiring. Consumers postpone major purchases. Inventory builds up. Supply exceeds demand. Stock markets stagnate as investors struggle to justify high valuations. Housing markets soften because fewer buyers can afford high mortgage rates. These early signs rarely make headlines. Yet they are the beginning of the turning point. When the cycle clearly moves into contraction, the process accelerates. Companies announce layoffs to reduce costs. Consumers reduce spending even further because uncertainty grows. Investors sell assets to protect capital. Governments face declining tax revenues. Fear spreads faster than optimism ever did. This fear causes people to act in ways that deepen the downturn. Job losses lead to reduced income, reduced spending, and further drops in business revenue. The psychological effect can be more powerful than the economic triggers themselves. Despite the pain of contraction, this phase plays a critical structural role. It clears out excesses built during expansion. Companies that grew too quickly return to more sustainable levels. Overpriced assets move back toward realistic valuations. Debt-heavy businesses that relied on cheap borrowing face necessary adjustments. Households re-examine their spending habits. Governments reassess policies. The cleanup is often messy, but it resets conditions required for healthy growth to emerge again. Every downturn, no matter how severe, carries the early markers of renewal. These markers do not appear in dramatic fashion. They show up as small signals that conditions are stabilizing. Inflation begins to slow. Interest rates stop rising and may gradually fall. Consumers regain confidence as prices stabilize. Some industries begin hiring again. Corporate earnings show improvement. These subtle improvements multiply over time. As confidence quietly returns, spending increases. Businesses invest again. Investors regain appetite for risk. This renewed momentum transforms into expansion once more. The transition from contraction to expansion is rarely recognized in real time. People tend to anchor to recent experiences. so those who suffered losses remain cautious even when conditions have improved. The reluctance to act early means that the most attractive opportunities are often seized by those who observe data rather than emotions. Investors who valued strong companies during downturns see their patience rewarded. Individuals who maintained discipline in their savings find themselves in a stronger position. Businesses that focused on efficiency during tough times gain competitive advantages when growth resumes. Understanding the internal logic of cycles also requires understanding how credit functions. Credit amplifies everything within a cycle, both the rise and the fall. When credit is cheap and easy to access, spending accelerates. When credit becomes expensive or scarce, economic activity contracts. Because credit influences housing, business investment, and consumer spending, it has an outsized impact on the cycle's turning points. Entire industries rely heavily on the cost of credit: construction, manufacturing, retail, and technology. Even small changes in interest rates affect these sectors dramatically. Another important driver of the cycle is productivity. Productivity increases when new technologies, improved processes, or better infrastructure enable people to produce more with the same amount of effort. Sustained productivity growth strengthens the long-term foundation of the economy and softens the severity of downturns. When productivity stagnates, expansion becomes harder to sustain, and the risks of overheating rise. Modern economies benefit from powerful waves of innovation: digital technology, artificial intelligence, automation, renewable energy, biotechnology. These waves shape the length and character of cycles. They can extend expansions, shorten recessions, or create entirely new industries that redefine economic structure. Globalization also influences cycles. When countries are interconnected through trade, investment, and supply chains, cycles spread more widely. A slowdown in one major economy can affect many others. At the same time, globalization allows economies to recover more quickly by accessing global markets, resources, and capital. Interconnectedness does not eliminate cycles, it synchronizes them. The global financial crisis demonstrated how quickly risk can spread through interconnected systems. Yet it also showed how coordinated responses can stabilize conditions. Demographics add another layer to the pattern. A younger population tends to support stronger consumption, higher borrowing, and faster expansion. An aging population spends differently, invests differently, and influences the pace of economic activity. Countries with aging populations often face slower long-term growth unless offset by innovation, immigration, or productivity gains. Demographics move slowly but shape economic potential across decades. Psychology remains the most powerful force. Optimism expands cycles, fear contracts them, and both tend to overshoot reality. People rarely behave in perfect alignment with economic fundamentals. Instead, they react to headlines, social trends, peer pressure, and emotional impulses. These reactions magnify the cycle's amplitude. When markets rise, people feel wealthier and spend more aggressively. When markets fall, even households with stable income reduce spending out of caution. This feedback loop makes cycles smoother or sharper depending on collective sentiment. Recognizing these behavioral patterns helps individuals avoid common traps. One of the most damaging traps is the assumption that current conditions will continue indefinitely. When interest rates are low, people assume they will stay low forever. When real estate prices rise, buyers assume they will always rise. When markets fall, investors assume recovery is far away. These assumptions distort decision-making. The disciplined approach is to observe not only where conditions stand but how quickly they are changing. Rate of change often reveals more than the absolute level. Another trap is reacting emotionally to short-term fluctuations. Economic noise is constant. Data releases, market movements, political events, and global headlines create distractions. If decisions are driven by short-term reactions, they often contradict long-term objectives. A person who invests based on monthly fluctuations will behave unpredictably, buying and selling at the wrong times. A business owner who responds impulsively to every change will find it difficult to create stability or plan strategically. Economic cycles reward long-term thinking and punish short-term panic. A more subtle trap is overconfidence during favorable conditions. When businesses perform well, leaders assume the success is entirely the result of skill, rather than partially the result of supportive economic conditions. When investors experience strong returns, they attribute these gains to expertise rather than the strength of the cycle. This overconfidence encourages risk-taking that becomes dangerous when conditions shift. The disciplined individual recognizes that favorable outcomes during a strong expansion do not guarantee future results. They separate skill from circumstance, and this awareness protects them during downturns. Cycles also expose structural weaknesses that remain hidden during good times. Debt, for example, may appear manageable when incomes are rising and interest rates are low. But when borrowing costs increase or revenue declines, the same debt becomes a burden. This applies to households, corporations, and governments. Cycles reveal which sectors, companies, and individuals have built resilience, and which have relied on unstable foundations. Resilience is the antidote to the negative effects of cycles. It does not eliminate volatility but reduces vulnerability. A resilient household maintains savings, controls debt, and avoids overextending during expansions. A resilient business manages cash flow carefully, avoids unnecessary leverage, and invests in efficiency. A resilient government plans long-term, rather than responding reactively. When downturns occur, resilience allows faster recovery and more effective action. Cycles influence careers as well. During expansions, job opportunities increase, salaries grow, and workers have more bargaining power. During downturns, hiring slows, competition increases, and career advancement becomes more challenging. Individuals who understand cycles plan accordingly. They strengthen skills during good times, position themselves competitively, and prepare financially for leaner periods. They understand that career trajectories are also cyclical, influenced by industry trends, technological shifts, and economic conditions. Investment strategies gain clarity when viewed through a cyclical lens. Buying assets during periods of pessimism and undervaluation has historically produced stronger long-term returns than buying during euphoric peaks. Yet fear prevents most individuals from acting when opportunities are greatest. A cycle-aware investor evaluates intrinsic value, considers long-term fundamentals, and ignores the emotional extremes of the market. They understand that volatility is not a signal to retreat but a signal to observe carefully. Housing decisions, 2. Benefit from awareness of cycles. Real estate prices rise during expansions because income, employment, and borrowing capacity increase. But price appreciation often slows or reverses when interest rates rise or when supply outpaces demand. A buyer who understands cycles evaluates timing carefully, avoiding periods of excessive exuberance. They recognize that owning property is not only about purchase price but about stability, affordability, and long-term sustainability. Business opportunities expand and contract with the cycle. During expansions, capital becomes more available, demand increases, and innovation accelerates. Entrepreneurs find it easier to launch new ventures. But competition also increases, and weaker business models can be overlooked when money is abundant. During downturns, many businesses struggle, but the ventures that survive often emerge stronger. Downturns expose inefficiencies and force clarity. They eliminate weaker competitors, reduce costs, and create openings for new players. When the economy re-accelerates, the strongest survivors often lead the new wave of growth. For entrepreneurs, understanding the cycle helps determine when to expand aggressively and when to focus on consolidation. It helps identify industries where demand will rise or fall based on broader conditions. Cycle awareness also influences personal finance. Saving becomes easier during expansions. But those who rely too heavily on good times risk being unprepared when conditions change. Individuals who build safety buffers reduce stress during downturns and can act decisively when opportunities appear. Saving is not merely a financial habit, it is a strategy for navigating cycles. Ultimately, the value of understanding cycles is the shift in perspective it provides. Instead of viewing economic events as isolated shocks, you begin to see them as components of a larger pattern. You interpret news differently. You recognize when fear is excessive or when optimism is unrealistic. You act more intentionally and less reactively. Over time, This shift compounds. Better decisions accumulate into meaningful advantages, stronger finances, smarter investments, more stable careers, and greater long-term security. The structure of economic cycles becomes clearer when observing how different groups within society react at each stage. Households, corporations, financial institutions, and governments all respond differently to expansion, tightening, contraction, and stabilization. Their interactions create the broader rhythm that defines the movement of the economy. Understanding these interactions provides deeper clarity on why cycles unfold with such consistency. Even in different eras, countries, and political systems, households respond strongly to income changes, job availability, credit conditions, and overall sentiment. When employment is abundant and wages are rising, households spend more freely. They take on mortgages, upgrade homes, purchase vehicles, travel, and invest in financial markets. This spending drives corporate revenue, which reinforces expansion. Conversely, when job security weakens or borrowing becomes expensive, households shift rapidly toward caution. They delay major purchases, reduce discretionary spending, and increase savings. The shift in household behavior is often the first indicator of a slowing economy, even before official data confirms it. Corporations respond primarily to demand, labor costs, borrowing costs, and competitive pressures. During strong expansions, businesses often overestimate future demand, leading them to expand too aggressively. They increase inventory, hire more employees, and commit to large capital expenditures. As costs rise or demand slows, these commitments become burdensome. Companies begin trimming expenses, delaying projects, and eventually reducing staff. Business confidence becomes highly sensitive to economic shifts, contributing to the acceleration of both expansions and contractions. Financial institutions amplify cycles because of their role in providing credit. When economic conditions improve, banks lend more readily. They loosen underwriting standards, extend credit to riskier borrowers, and support the creation of new enterprises. Easy credit accelerates the expansion of real estate, equity markets, and business investment. But when economic indicators weaken, these same institutions tighten access to credit. Lending slows, approvals become stricter, and liquidity declines. This tightening often deepens recessions because it restricts spending and investment at the exact time households and businesses need support. Governments influence cycles through spending, taxation, regulation, and monetary policy. Fiscal stimulus, infrastructure investment, and reduced taxes can accelerate recovery during economic weakness. Conversely, excessive spending during expansions can contribute to overheating. Economic policy often reacts with a delay, which makes timing crucial. If stimulus arrives too late, it risks amplifying inflation rather than stabilizing growth. Monetary authorities, such as central banks, play a pivotal role through interest rate adjustments. Lower rates stimulate borrowing and investment, higher rates slow the economy. These tools are powerful, but they also influence cycles with lags, meaning today's policy may only affect the economy months or even years later. Because these four groups, households, businesses, financial institutions, and governments, move in interconnected ways, their behavior tends to reinforce whatever stage the economy is in. When confidence is high, each group becomes more aggressive, pushing the cycle upward. When confidence collapses, each group becomes defensive, intensifying the downturn. This collective behavior explains why economic cycles often appear exaggerated and why transitions can feel abrupt even though the underlying causes accumulate slowly. Technological progress adds another dynamic layer to cycles. Breakthrough innovations can create long waves of expansion when productivity surges. For example, the widespread adoption of personal computers, the internet, and mobile technology each contributed to prolonged periods of economic growth by enabling new industries, increasing efficiency, and lowering operational costs. Innovations like artificial intelligence, automation, clean energy, and biotechnology may shape future cycles in similar ways. However, technological transitions can also create disruptions. Industries that fail to adapt lose competitiveness, leading to job losses and economic friction in the short term. Over time, though, Technology tends to increase productivity and raise the baseline of economic potential. Historical cycles reveal that financial markets often move ahead of the broader economy. Investors react to expectations about the future rather than current conditions. Stock markets frequently rise before an economic recovery becomes visible and fall before a recession is fully recognized. This forward-looking nature means that markets often exaggerate fears and hopes. Investor psychology drives volatility as much as fundamental economic data. When optimism spreads, valuations rise quickly. When fear dominates, even strong companies see their prices fall. Understanding this anticipatory behavior allows individuals to interpret market movements with greater clarity, preventing emotional decisions. The movement of capital across borders also shapes modern cycles. Global investors seek yields, safety, and opportunity wherever they appear, moving trillions of dollars between regions. When capital flows strongly into a country, local asset prices rise, currencies strengthen, and investment increases. When capital retreats, prices fall, currencies weaken, and financing becomes more difficult. This mobility of capital can amplify both expansion and contraction, making cycles more synchronized across the world. A shift in interest rates in one major economy can influence dozens of others. As a result, local conditions increasingly depend on global dynamics. The labor market plays a central role in shaping economic direction. Employment influences consumer confidence, spending power, and political sentiment. During expansions, tight labor markets push wages higher. Higher wages support consumption but also increase costs for businesses, contributing to inflationary pressure. During downturns, job losses weaken demand sharply. Governments often intervene to support employment through subsidies, public sector hiring, or stimulus programs. The health of the labor market is one of the most important indicators for assessing where the economy stands in the cycle. Inflation is another key driver. Moderate inflation can accompany healthy growth. But when inflation rises too quickly, it destabilizes consumer behavior and corporate planning. High inflation erodes purchasing power, disrupts budgets, and pressures central banks to raise interest rates. These higher rates slow borrowing and investment, often tipping the economy into contraction. Conversely, deflation, falling prices, can also be dangerous because it encourages consumers to delay purchases and makes debt more burdensome. Stable inflation supports stable cycles. Instability often marks the transition from expansion to slowdown. Savings and investment patterns also reflect cyclical behavior. During expansions, savings rates tend to fall as people feel confident spending. Investment increases as businesses anticipate future growth. During downturns, households save more, and businesses delay projects. These shifts influence credit availability, interest rates, and economic momentum. High savings can provide a foundation for recovery, while low savings can prolong downturns. Housing markets illustrate cyclical movement vividly. Real estate prices respond to interest rates, income, sentiment, and demographic demand. During expansions, strong job markets and low borrowing costs drive home purchases. Prices rise, construction activity increases, and household wealth grows. But when interest rates climb or demand softens, prices stagnate or fall. Construction slows, reducing employment in related industries. Because real estate is often the largest asset for households, changes in housing markets significantly influence consumer behavior and confidence. Corporate earnings follow cyclical patterns as well. During expansions, rising demand boosts revenue and profits. Companies invest in new projects and hire more employees. During contractions, earnings decline, prompting cost-cutting, layoffs, and operational restructuring. Investors closely track earnings because they reflect the health of the business sector. Declining earnings often precede broader economic weakness, while improving earnings signal recovery. Consumer sentiment surveys often reveal the psychological side of cycles. When optimism is high, consumers spend more and borrow confidently. When pessimism rises, they pull back, because consumer spending comprises a large share of most economies. Shifts in sentiment can significantly influence economic direction. Sentiment does not always align with data. People may feel pessimistic even during stable conditions or optimistic even when risks are high. Understanding sentiment helps interpret whether behavior is driven by fundamentals or emotion. Government policy responses can either soften or exacerbate cycles. Well-timed fiscal support can help stabilize incomes and demand. Poorly timed stimulus, however, can push the economy into overheating or create long-term imbalances. Regulatory changes also influence the cycle. Looser regulations may stimulate growth during early expansions but contribute to instability later. Stricter regulations may reduce risk during late expansions but also slow recovery if implemented too aggressively. Natural resources, supply chains, and geopolitical factors introduce additional complexity. Resource shortages, like energy or food disruptions, can trigger inflation and slowdowns. Global supply chain bottlenecks can create shortages and increase costs. Geopolitical tensions, trade conflicts, wars, sanctions, can disrupt markets and shift investment flows. These factors rarely create cycles on their own, but they can intensify transitions or accelerate turning points. A deeper understanding of cycles requires examining debt dynamics. Debt enables growth by allowing households and businesses to spend beyond their current income. But excessive debt creates fragility. When interest rates rise or incomes fall, debt burdens become heavier. Defaults increase, reducing confidence in financial institutions. When debt expands faster than the economy for long periods, the cycle becomes more vulnerable to sharp reversals. Sustainability matters. Debt that funds productive investments strengthens an economy, while debt that funds consumption or speculation weakens it. The distribution of wealth influences how cycles affect different groups. Wealthier households often have diversified investments and savings buffers, allowing them to withstand downturns. Lower-income households face greater vulnerability due to limited savings and reliance on employment income. Economic cycles, therefore, have unequal impacts. During expansions, inequality may widen as asset prices rise. During downturns, those without assets suffer more. Economic resilience at the societal level depends on how broadly financial stability is shared. For individuals, the practical application of understanding cycles lies in managing decisions across multiple dimensions: saving, investing, borrowing, career planning, and personal consumption. Recognizing when conditions are favorable helps shape appropriate risk-taking. Recognizing when conditions are deteriorating encourages preparation and prudence. The key insight is not to predict exact turning points but to observe the direction and momentum of change. Decision-making becomes sharper when aligned with underlying conditions. During rapid expansion, restraint protects against overexposure. During peak conditions, caution helps anticipate reversal. During contraction, discipline prevents panic. During early recovery, confidence enables timely action. The advantage comes not from perfect timing but from avoiding extremes, excessive optimism or excessive fear. Cycles also shape long-term strategies. Diversification protects against unforeseen shocks. Maintaining liquidity ensures flexibility. Avoiding excessive leverage reduces vulnerability. Investing consistently through different phases captures long-term growth. Aligning career development with structural trends enhances resilience. Building skills during stable periods creates opportunities during transitions. Cycles reflect the interplay of human psychology, economic fundamentals, and adaptive behavior. They are not mechanical patterns but living movements shaped by millions of decisions. Because people tend to overreact, cycles tend to overshoot. Because fundamentals eventually reassert themselves, cycles tend to correct. This dynamic never disappears. It adapts to new technologies, new political systems, and new global realities, but the underlying rhythm persists. A society that understands cycles makes better collective decisions. It avoids excessive optimism in good times and excessive pessimism in bad times. It invests in long-term productivity, maintains stable institutions, and prepares for inevitable fluctuations. Individuals equipped with this understanding operate with more clarity. They interpret market movements, job changes, and policy shifts through a broader lens. They remain steady even when others overreact. Economic cycles, when viewed in isolation, may seem unpredictable or chaotic, but when observed as repeated patterns shaped by incentives, constraints, and human tendencies, they reveal strong internal logic. This logic provides a framework for navigating complexity. Instead of reacting emotionally, individuals can respond strategically. Instead of fearing downturns, they recognize the opportunities embedded within them. Instead of assuming stability, they prepare for change. Over time, this approach compounds into greater financial stability, stronger decision-making, and a deeper understanding of how the world actually works. The long-term trajectory of an economy is shaped not only by cyclical forces but also by structural foundations that evolve across decades. Cycles operate within these deeper structures, amplifying or weakening them depending on the direction of movement. Understanding structural forces provides context for why certain economies flourish, why others stagnate, and why some recover quickly from downturns while others struggle for years. These underlying elements shape the boundaries of what a cycle can achieve and determine the resilience of a society as it moves through periods of growth and contraction. One of the most important structural forces is productivity. Productivity defines how efficiently an economy can transform labor, capital, and resources into output. When productivity rises, living standards increase, wages tend to grow, and businesses operate with greater profitability. This creates a virtuous foundation that supports long-term growth. Productivity increases through innovation, education, technological adoption, infrastructure improvements, and better organizational practices. When these elements align, economies experience long-term upward momentum regardless of short-term volatility. However, productivity does not grow uniformly. Some industries benefit from rapid innovation, while others progress more slowly. Economies that rely heavily on low productivity sectors often face chronic challenges. This disparity affects how cycles behave. During expansions, high productivity sectors accelerate growth, while low productivity sectors limit its sustainability. During downturns, highly efficient industries recover faster, while inefficient ones lag. The composition of an economy therefore shapes the rhythm of its cycles. Human capital plays a central role in productivity. A skilled and adaptable workforce enables economies to integrate new technologies, shift toward high-value industries, and respond flexibly to disruption. Education systems, training programs, and cultural attitudes toward learning all contribute to the strength of human capital. Economies with strong human capital navigate cycles more effectively because workers are better able to adjust to changing conditions. Those with weaker human capital face longer-lasting disruptions as industries evolve. Infrastructure is another structural factor influencing long-term performance. Efficient transportation systems, reliable energy networks, digital connectivity, and robust logistics enable economic activity to expand. During downturns, strong infrastructure mitigates losses by lowering costs and improving resilience. During recoveries, it accelerates expansion by enabling businesses to scale more efficiently. Investments in infrastructure often have a multiplier effect, stimulating demand in the short term while strengthening productivity in the long term. Institutional quality profoundly influences economic outcomes. Stable legal systems, predictable regulations, transparent governance, and effective public administration reduce uncertainty and encourage long-term investment. When institutions are strong, economies can attract capital, foster innovation, and maintain confidence through downturns. Weak institutions, by contrast, undermine trust, discourage investment, and amplify the severity of recessions. Institutional strength determines whether policy responses are timely, credible, and effective. It also determines whether markets function efficiently or become distorted by corruption or inconsistency. Demographics remain a slow-moving but powerful structural force. A growing, youthful population tends to support robust consumption and a dynamic labor market. Economies with strong demographic momentum often experience sustained demand, facilitating smoother recoveries and stronger long-term growth. Conversely, aging populations reduce labor supply, slow consumption, and increase pressure on social systems. These demographic realities shape how cycles behave. Expansions may be weaker in aging societies. and recoveries may take longer due to limited labor force growth. Global integration adds another layer of structural complexity. Economies deeply embedded in global trade networks gain access to markets, capital, and technology. They can specialize in competitive industries, benefit from economies of scale, and diversify risks. However, integration also exposes them to global shocks, such as financial crises, supply chain disruptions, or geopolitical tensions. The balance between integration and self-sufficiency becomes a defining factor for resilience. Economies that manage this balance well benefit from global opportunities while maintaining stability during global downturns. Environmental and resource factors shape long-term economic capacity as well. Access to energy, water, agricultural land, and raw materials influences the cost structure of industries and affects resilience during external shocks. As the global economy transitions toward cleaner energy, countries with strong renewable potential may gain structural advantages. Meanwhile, those dependent on declining or volatile resources face pressure to diversify. Environmental risks, such as climate change, natural disasters, and resource depletion, also influence the behavior of cycles by introducing sudden shocks that accelerate turning points. Cultural attitudes toward risk, innovation, and cooperation shape economic structure in ways that are often overlooked. Societies that encourage experimentation and tolerate failure tend to innovate faster. Societies that prioritize stability over volatility may avoid extreme cycles but also experience slower growth. Trust within a society reduces transaction costs and enables smoother coordination between economic actors. These cultural elements evolve slowly but have a powerful influence on long-term performance. Technological diffusion, the speed at which new technologies spread across industries, defines how quickly structural improvements take root. An innovation may exist, but if adoption is slow, productivity gains remain limited. Economies with flexible regulations, adaptable workforces, and strong infrastructure adopt new technologies more rapidly. This accelerates long-term growth and mitigates the severity of downturns. Slow adoption, by contrast, traps economies in outdated models and weakens their potential to recover from shocks. Structural imbalances can accumulate silently over time, creating vulnerabilities that cycles eventually expose. For example, a prolonged period of low interest rates may encourage excessive borrowing, inflate asset prices, and distort investment decisions. These imbalances may appear harmless during expansions but become dangerous when conditions shift. Similarly, underinvestment in infrastructure or education may seem manageable in the short term but will constrain growth and increase fragility in the long term. Understanding structural imbalances helps explain why some downturns become crises while others remain mild corrections. Income and wealth distribution significantly shape how cycles impact society. When wealth is concentrated in a small segment of the population, economic gains from expansions may not translate into broad-based improvements. Consumption patterns become uneven, making expansions more fragile. During downturns, vulnerable households with limited savings suffer disproportionately. Deepening recessions, more balanced distribution enhances resilience, as a larger share of households can maintain spending even during difficult periods. Social safety nets play a critical role in stabilizing cycles. Programs that support unemployed workers, provide healthcare access, or assist low-income households can reduce the severity of downturns by maintaining consumption. Effective safety nets shorten recessions and support quicker recoveries. Weak safety nets allow downturns to cascade through the economy, turning temporary disruptions into prolonged hardships. The design of these systems shapes how societies absorb shocks and transition between stages of the cycle. Innovation ecosystems, the networks of universities, research institutions, businesses, and investors, determine how effectively an economy generates new ideas. During expansions, strong innovation ecosystems produce new industries and technologies. During downturns, they provide pathways for reinvention and create opportunities for emerging sectors to develop. Economies with weak innovation ecosystems risk becoming trapped in outdated industries, experiencing slower recoveries and limited long-term growth. Credit markets form another crucial structural component. When credit systems are deep, efficient, and well-regulated, they allocate capital to productive uses and adjust smoothly to changing conditions. When credit markets are shallow or distorted, capital flows inefficiently, amplifying the volatility of cycles. Well-functioning credit markets help businesses invest steadily, households borrow responsibly, and governments finance long-term projects. Dysfunctional credit markets concentrate risk and trigger instability when cycles shift. Trade structure shapes resilience as well. Economies highly dependent on a narrow set of exports face greater vulnerability during global downturns or commodity price fluctuations. Diversified economies can absorb shocks more effectively. The ability to shift production toward higher-value industries determines whether an economy climbs the development ladder or remains stuck in low-value activities. Structural diversification creates a broader base for long-term stability and growth. Urbanization influences economic potential by concentrating economic activity, talent, and innovation. Well-planned urbanization improves productivity, facilitates efficient labor markets, and supports vibrant economic ecosystems. Poorly planned urbanization, however, leads to congestion, pollution, and infrastructure strain, which erode productivity and weaken resilience. The design and management of cities play a long-term role in shaping the trajectory of cycles. Public debt and fiscal flexibility matter greatly in determining how governments respond to downturns. Economies with manageable debt levels can deploy stimulus, support households, and invest counter-cyclically without jeopardizing long-term stability. Economies with excessive debt face constraints. High debt burdens increase borrowing costs, limit policy options, and heighten vulnerability to external shocks. Fiscal discipline during expansions creates room for effective responses during downturns. Monetary frameworks and central bank credibility influence expectations. When central banks maintain stable inflation and communicate clearly, businesses and households make better long-term decisions. Predictability reduces risk, supports investment, and stabilizes cycles. When credibility is weak, inflation expectations become unstable, creating volatility and undermining growth. Effective monetary frameworks anchor the entire system. Environmental sustainability increasingly determines long-term economic stability. Economies that overexploit natural resources face eventual constraints, rising costs, and ecological disruptions that can trigger economic volatility. Transitioning toward sustainable practices reduces long-term risks, fosters innovation, and aligns economic growth with environmental stability. Ignoring sustainability may allow short-term gains but increases long-term fragility. Migration and labor mobility shape the adaptability of the workforce. Economies with flexible labor markets adjust more quickly to changes in demand, reallocating workers to emerging industries. Restrictive labor systems slow adjustment and prolong downturns. Migration can alleviate demographic decline, increase labor supply, and support long-term growth when managed effectively. Entrepreneurship acts as a structural engine of renewal. New businesses create jobs, introduce innovations, and challenge inefficient incumbents. During downturns, entrepreneurship can accelerate recovery by identifying new opportunities and repositioning economic activity. Structural barriers to entrepreneurship, bureaucracy, limited access to capital, restrictive regulations, slow this process, making recoveries weaker and expansions shorter. A society's collective mindset toward the future also shapes long-term resilience. Societies that plan forward, invest in education, maintain institutional trust, and adapt to global trends build structural advantages that compound over decades. Societies focused narrowly on short-term gains often fall behind, accumulating vulnerabilities that cycles eventually expose. Forward-looking governance and social cohesion strengthen economic foundations far beyond the effects of any single policy. The interaction between structural and cyclical forces determines an economy's long-term path. Cycles create movement, but structure defines direction. Strong structural foundations support steady growth, soften downturns, and accelerate recoveries. Weak structures create fragility, amplify volatility, and lengthen recessions. Understanding both forces allows individuals, businesses, and policymakers to interpret economic signals with clarity and act with strategic foresight. For households, awareness of structural trends guides decisions about career development, savings, investment, and geographic mobility. Aligning with high productivity sectors improves long-term earning potential. Investing in education and skills provides resilience against automation and technological shifts. Understanding demographic trends helps anticipate changes in housing markets, healthcare needs, and pension systems. For businesses, structural awareness shapes strategy. Companies that align investments with long-term trends, such as technology, sustainability, demographic shifts, and global integration, position themselves for durable success. Those that ignore structural realities risk stagnation. Even during expansions, strategic foresight allows businesses to navigate cycles with greater stability. For investors, structural forces define long-term value. Industries driven by strong structural tailwinds often outperform over time, even if short-term volatility appears. Recognizing structural decline helps investors avoid sectors vulnerable to disruption. Understanding global trends enables more balanced, diversified portfolios that withstand cyclical turbulence. For policymakers, structural clarity supports responsible decision-making. Investing in human capital, infrastructure, innovation, and sustainability strengthens long-term potential. Maintaining stable institutions and fiscal discipline creates resilience. Policies aligned with structural forces guide the economy toward sustainable growth rather than temporary surges vulnerable to reversal. Ultimately, the relationship between structural forces and cycles reveals the deeper logic of economic behavior. Short-term movements matter, but long-term foundations determine whether societies thrive or struggle. An economy that understands both dimensions can navigate uncertainty with confidence. Over time, this understanding builds not only stability but also the capacity for enduring prosperity. Economic behavior becomes far easier to interpret when viewed through the lens of incentives. Incentives shape choices, and choices accumulate into patterns that define the direction of the broader economy. These incentives operate at every level, from households deciding how much to save or spend, to corporations determining how much to invest, to governments choosing policies that influence long-term stability. By observing how incentives shift under different conditions, one can anticipate how individuals and institutions will respond even before large-scale changes appear in the data. Households respond strongly to incentives related to income, security, opportunity, and expectations. When wages rise and job stability increases, households feel encouraged to take long-term financial steps such as buying property, investing in education, or expanding consumption. These actions reinforce economic expansion. When wages stagnate or uncertainty increases, households instinctively pull back. They save more, reduce discretionary spending, and avoid new liabilities. Even subtle changes in consumer confidence shape the trajectory of the economy because household consumption forms such a large share of total activity. Small adjustments in perception can lead to meaningful shifts in aggregate demand. Corporations respond to incentives through profit expectations, competitive pressures, input costs, and regulatory environments. When demand is strong and borrowing costs are low, businesses expand aggressively. They hire more workers, open new branches, and invest in capacity. These steps further stimulate demand, creating a feedback loop that intensifies expansions. But when costs rise, demand weakens, or regulation tightens, the incentive structure changes. Businesses scale back, cut expenses, and become cautious about hiring or investment. Because corporate decisions influence employment and wages, their behavior often accelerates the movement of cycles. Financial institutions are driven by incentives related to risk, return, liquidity, and regulation. During optimistic periods, the incentive to lend increases because default risk appears low and profit opportunities rise. Lending standards loosen, allowing a broader range of borrowers to access credit. This influx of credit fuels consumption and investment, amplifying the upward phase of the cycle. During uncertain periods, the incentive flips. Banks restrict lending to preserve capital. and credit becomes harder to access. This contraction in credit supply slows economic activity even before other indicators weaken. Because credit is a central artery of the economy, changes in financial incentives are among the most powerful drivers of turning points. Governments respond to incentives through political pressures, budget constraints, economic objectives, and public sentiment. During expansions, rising tax revenue allows governments to increase spending without raising taxes. Political incentives often favor visible projects or programs that demonstrate progress. However, this can create imbalances if structural issues are ignored. During downturns, pressure grows for stimulus measures. Even when public finances are strained, policymakers face incentives to stabilize employment, support key industries, or ease credit conditions. But poorly timed or poorly designed policies can worsen imbalances or exacerbate inflation. Understanding these incentives helps explain why government actions sometimes appear inconsistent or reactive. Interest rates represent one of the most potent incentive mechanisms in economic systems. Low interest rates encourage borrowing, investment, and consumption. High interest rates discourage them. Because interest rates influence the cost of debt, they shape housing markets, business investment decisions, corporate valuations, and government borrowing. A single percentage point shift in interest rates can reshape the incentive landscape for millions of actors. This is why changes in interest rates often precede major shifts in economic direction. Inflation also reshapes incentives. When inflation is low and stable, consumers and businesses plan confidently. But when inflation rises quickly, the incentive structure becomes distorted. Consumers may accelerate purchases to avoid future price increases. Businesses may raise prices preemptively. Savers lose purchasing power, encouraging them to spend or invest rather than hold cash. High inflation also incentivizes governments and central banks to tighten policy, which in turn influences credit and borrowing conditions. When inflation falls too low or shifts toward deflation, the incentive reverses. Consumers delay purchases. Businesses struggle to maintain revenue, and economic momentum weakens. Exchange rates influence incentives related to trade, investment, and global capital flows. A strong currency encourages imports and reduces export competitiveness. A weak currency boosts exports but increases the cost of imported goods. When exchange rates fluctuate sharply, businesses face uncertainty, which can reduce investment and hiring. Capital moves across borders in response to relative returns, shifting currency valuations further. These movements influence manufacturing decisions, supply chain planning, and international investment strategies. Technology reshapes incentives by altering the cost-benefit structure of entire industries. Automation reduces labor costs, encouraging businesses to invest in machinery rather than expand their workforce. Artificial intelligence reduces the cost of information processing, allowing companies to scale more efficiently. Breakthroughs in energy, biotechnology, and materials science can dramatically reduce input costs or open new markets. These shifts often occur gradually, but their cumulative effect significantly alters the long-term direction of the economy. The incentives created by new technologies shape where capital flows, where jobs appear, and which industries rise or decline. Patterns of human behavior remain consistent across cycles because incentives interact with cognitive biases. Individuals seek certainty, avoid loss, follow social norms, and respond emotionally to perceived threats or opportunities. These psychological tendencies amplify the effect of incentives. When markets rise, people feel pressure to participate to avoid missing out. When markets fall, fear drives them to withdraw even if fundamentals remain stable. Herd behavior magnifies volatility and shapes cycles more powerfully than pure economic logic. Risk perception also affects responses to incentives. During expansions, risk appears lower than it actually is, encouraging speculative behavior. Borrowers take on more debt. Investors pursue higher returns, and businesses expand aggressively. During downturns, risk appears higher than reality, causing overreaction. Borrowers stop taking loans. Investors retreat to safe assets, and businesses cut more deeply than necessary. Because perception lags reality, Human reactions often intensify economic turning points. One of the most important insights is that incentives rarely operate in isolation. They compound each other. Low interest rates encourage borrowing. Rising asset prices reinforce optimism. Optimism encourages risk-taking. Risk-taking fuels further borrowing. Borrowing boosts spending. Spending increases profits. Profits justify expansions. This chain reaction continues until a constraint emerges. When it does, the incentives reverse. Rising inflation triggers higher interest rates. Higher interest rates increase borrowing costs. Higher costs weaken demand. Weakened demand reduces profits. Lower profits reduce hiring. Reduced hiring weakens consumption. The cycle begins to slow. Understanding these incentive chains helps explain why cycles often seem powerful and self-propelling. They are not random. They are the natural outcome of thousands of behavioral loops interacting simultaneously. Anyone who can identify these loops early gains a significant advantage, whether as an investor, a business leader, or simply an individual making prudent long-term decisions. Cycles also influence how wealth is created and destroyed. During expansions, asset prices often rise faster than incomes, benefiting those who own property, stocks, or businesses. During downturns, asset prices typically fall faster than incomes, harming the same groups. This dynamic helps explain why the wealthy tend to become wealthier during long expansions and why recessions tend to widen inequality. Those without assets rely heavily on employment income, which is more vulnerable during downturns. Those with assets rely on valuation, which is more responsive to cycles. Awareness of this dynamic highlights the importance of building diversified, long-term assets during stable periods. Long-term financial stability for individuals comes from aligning personal incentives with structural and cyclical realities. Saving during expansions builds buffers for downturns. Avoiding excessive debt prevents vulnerability during tightening phases. Investing consistently, regardless of market sentiment, captures long-term growth while avoiding emotional extremes. Developing skills relevant to long-term structural trends ensures employability even when industries evolve. Understanding how incentives shift allows individuals to navigate uncertainty with greater clarity. The role of expectations cannot be overstated. Future expectations shape current behavior. If businesses expect higher demand in the future, they invest more today. If households expect rising prices, they accelerate purchases. If investors expect higher interest rates, they reallocate portfolios. Expectations influence inflation, housing markets, labor markets, and consumption patterns. Because expectations can be self-fulfilling, managing them becomes a central challenge for policymakers. Central banks focus heavily on guiding expectations. Their communication strategies aim to create predictability around inflation, interest rates, and policy direction. When the public trusts that inflation will remain stable, wage negotiations, investment decisions, and pricing behavior remain aligned. When trust erodes, expectations become unanchored, creating volatility. The credibility of institutions becomes a critical stabilizing force. Once credibility is lost, restoring it becomes costly and slow. Cycles also influence innovation. During expansions, capital flows more freely to experimental ventures. Startups receive funding, research accelerates, and new technologies emerge. During downturns, funding becomes scarce, forcing companies to focus on efficiency. Innovations that reduce costs or improve productivity gain prominence. Although downturns reduce overall investment, they often accelerate essential improvements and eliminate inefficient competitors, paving the way for stronger growth during recovery. Geopolitical forces interact with cycles in complex ways. Wars, trade conflicts, sanctions, and diplomatic tensions reshape incentives for businesses, investors, and governments. These events can disrupt supply chains, alter trade relationships, and shift global capital flows. They often introduce uncertainty, which weighs on investment and innovation. However, geopolitical shifts can also create new opportunities, such as the emergence of alternative markets or the development of new industries required for strategic independence. Energy markets represent a critical intersection between structural forces and cyclical behavior. Energy availability and cost influence nearly every industry. During periods of stable energy supply, economies grow smoothly. When energy prices spike, inflation rises, production costs increase, and consumption weakens. Energy transitions, such as the shift toward renewable sources, create new industries while disrupting existing ones. These transitions shape long-term growth potential and influence the pace and character of economic cycles. The behavior of global supply chains adds another dimension. Highly efficient supply chains reduce costs during stable periods but introduce fragility during disruptions. When supply chains break, production stops, prices rise, and economic momentum slows, as companies redesign supply chains for resilience rather than efficiency. Incentives shift toward diversification, regional balance, and redundancy. This structural shift influences long-term economic performance. Cycles also shape global power dynamics. Economies with strong structural foundations tend to recover faster from downturns, strengthening their geopolitical influence. Economies with persistent structural weaknesses struggle to regain momentum, weakening their global position. Over decades, cycles magnify differences in institutional quality, innovation capabilities, demographic health, and social cohesion. These differences shape not only economic outcomes but also political stability and global influence. The interplay between cycles and political behavior is significant. During expansions, political stability tends to increase as citizens experience rising prosperity. Governments gain support, and political discourse becomes less polarized. During downturns, dissatisfaction rises, political fragmentation increases, and social tensions intensify. Economic stress often results in demands for policy changes, leadership shifts, or institutional reforms. If political responses deepen polarization or uncertainty, economic recovery becomes more difficult. If political leadership guides societies calmly through downturns, recovery strengthens. Cycles also influence migration. During expansions, labor shortages attract workers from other regions. During downturns, job losses reduce migration or encourage return migration. These flows influence housing markets, wage dynamics, cultural integration, and long-term demographic health. Migration acts as both a stabilizing force, filling labor gaps, and a stressor when rapid inflows test social systems. Understanding migration as part of cyclical behavior provides insight into long-term demographic trends. Another important layer is the relationship between technology and labor. As technology evolves, some jobs disappear while new ones emerge. This transition creates friction in the labor market. During expansions, job displacement is easier to absorb because new opportunities appear. During downturns, displacement becomes more painful because job creation slows. The speed at which workers can transition to new roles determines whether technological progress strengthens or destabilizes the economy. Cycles influence consumption patterns as well. During expansions, households feel wealthier and pursue higher quality goods, travel, entertainment, and investment in education. During downturns, priorities shift toward essentials. These changes reshape entire industries. Luxury goods, travel, and discretionary services contract sharply during recessions, while essential goods remain stable. Understanding these patterns helps businesses align strategies with economic conditions. Economic cycles also serve an essential cleansing function. They remove inefficiencies, force restructuring, and discipline excessive risk-taking. Although painful, downturns reset the system by eliminating underperforming businesses, reducing speculative excess, and clarifying long-term priorities. Expansions, meanwhile, reward innovation, entrepreneurship, and productivity. This alternation between pruning and growth creates economic renewal. Over long horizons, cycles become the rhythm through which economies evolve. They reveal vulnerabilities, highlight strengths, and determine which institutions, businesses, and individuals flourish. Those who understand cycles interpret change not as chaos but as sequence. They recognize when to advance, when to retreat, and when to remain patient. They avoid emotional extremes and make decisions grounded in long-term logic. Ultimately, cycles mirror human behavior on a collective scale. They reflect optimism, fear, ambition, caution, excess, and correction. They reveal that progress is rarely linear but moves in waves shaped by incentives, structures, psychology, and external shocks. The more deeply one understands these interactions, the more confidently one can navigate not only economic life but also strategic decisions across all areas of life. Economic development over long horizons depends not only on the behavior of cycles, incentives, and structural forces, but also on how individuals and societies learn from previous periods of expansion and decline. Learning determines whether mistakes are repeated or avoided, whether institutions strengthen or weaken, and whether long-term strategies become clearer or remain reactive. This learning process shapes resilience. Economies that learn effectively grow stronger with each cycle, while those that fail to internalize lessons accumulate vulnerabilities that eventually lead to deeper corrections. The importance of learning becomes clear when examining how countries respond to financial crises. Some nations, after experiencing severe downturns, implement reforms that improve institutional quality, strengthen regulatory oversight, and reduce systemic risks. These reforms create a more stable foundation for future growth. Others, however, revert to previous behaviors once the crisis fades, allowing imbalances to build again. The difference lies in whether societies recognize the roots of instability or focus only on short-term recovery. Learning transforms crises into catalysts for improvement, while the absence of learning turns them into repeating patterns. Businesses, too, demonstrate varying levels of learning throughout cycles. Companies that study the causes of past failures adjust their strategies to reduce future vulnerability. They diversify revenue streams, strengthen balance sheets, improve operational efficiency, and enhance risk management. These actions position them to navigate downturns more effectively and to capitalize on opportunities when conditions improve. By contrast, businesses that fail to reflect on past challenges often repeat the same mistakes, such as overexpansion during booms, excessive leverage, or misallocation of capital. Learning becomes a competitive advantage that compounds over time. Households also learn from cycles, though the process is often slower and influenced by emotional responses. During expansions, households may overextend themselves, taking on more debt than they can manage. During downturns, the resulting stress can lead to lasting caution, encouraging more careful financial planning. Some individuals emerge from recessions with stronger habits, steady saving, emergency funds, and disciplined investment strategies. Others, however, fall into patterns of fear that limit long-term growth. The ability to extract practical lessons from economic volatility determines whether households achieve stability or remain vulnerable. Learning becomes most effective when supported by transparent information. Data availability, financial literacy, public communication, and institutional openness directly influence how societies interpret economic events. When information is clear and accessible, individuals make better decisions. When information is confusing, incomplete, or distorted, learning becomes difficult and misinterpretations flourish. Economic progress depends not only on the performance of systems but also on the clarity with which those systems are understood. A significant challenge in economic learning lies in the difference between long-term logic and short-term perception. In the short term, people typically prioritize immediate concerns, job security, rising prices, market fluctuations, long-term patterns, however, unfold slowly and may be overlooked. Effective learning requires bridging this gap, understanding how present actions shape future conditions, recognizing the cyclical nature of risk, and avoiding conclusions based solely on temporary fluctuations. This capacity for long-term thinking distinguishes societies that sustain progress from those that oscillate between crisis and partial recovery. Another important dimension is institutional memory. Institutions, governments, central banks, financial regulators must remember past crises to prevent future ones. Policies designed after major downturns are often intended to reduce specific vulnerabilities. Over time, however, as memories fade and political pressures shift, institutions may relax standards or dismantle protective measures. Strong institutional memory maintains discipline even when conditions appear stable. Weak institutional memory allows complacency to grow. transforming small imbalances into systemic risks. Learning also influences how societies evaluate risk. Risk is inherent in economic activity, but its perception changes across cycles. During expansions, optimism can erode caution, reducing the perceived importance of risk management. During downturns, fear can distort risk perception in the opposite direction, discouraging innovation and investment. Balanced learning maintains a steady understanding of risk independent of short-term emotional impulses. This stability supports healthier financial behavior and reduces volatility. Adaptability, an outcome of learning, is crucial for long-term resilience. Economies that adapt quickly to technological, demographic, or geopolitical changes maintain a stable growth trajectory. Those that resist adaptation face prolonged stagnation. Adaptability requires willingness to update outdated strategies, reallocate resources, and embrace new opportunities. It also requires recognizing when traditional models no longer align with structural realities. The combination of learning and adaptability forms the foundation of strategic foresight. Strategic foresight, the ability to anticipate long-term trends and act proactively, shapes the most successful economic outcomes. It requires understanding the forces that drive structural change, the incentives that influence behavior, and the cycles that create fluctuations. With foresight, societies can prepare for demographic transitions, manage technological disruption, strengthen institutions, and maintain sustainable investment. Without foresight, they become reactive, absorbing shocks rather than shaping their future trajectory. At the level of individuals, strategic foresight enhances financial security. Recognizing long-term trends such as automation, demographic aging, or resource constraints helps guide decisions about education, career paths, savings, and investment. Individuals who align their choices with long-term trends reduce vulnerability to cyclical fluctuations. Those who ignore these trends risk finding themselves in shrinking industries, facing unstable income, or missing opportunities for growth. Personal foresight becomes a form of resilience. Investors also benefit from foresight. Markets move in cycles, but their long-term direction depends on structural forces. Understanding these forces allows investors to distinguish between temporary volatility and fundamental shifts. It helps identify sectors likely to thrive over decades, manage risk effectively, and avoid emotional reactions to short-term price movements. Long-term investing becomes most successful when guided by rational analysis rather than immediate sentiment. At the national scale, countries that combine learning, adaptability, and foresight tend to achieve more stable and sustainable development. They invest in education, maintain strong institutions, cultivate innovation, and prepare for demographic transitions. They build infrastructure ahead of demand rather than after shortages appear. They strengthen regulatory frameworks without stifling growth. These societies maintain confidence through downturns and accelerate during recoveries, compounding advantages over time. The global economy reinforces the importance of these capabilities. As economies become more interconnected, shocks spread quickly. Supply chain disruptions, financial crises, pandemics, or geopolitical tensions can affect countries even if the initial disturbance occurs elsewhere. Learning and foresight help nations anticipate such vulnerabilities and develop mitigation strategies. Adaptability enables rapid response to global shifts, maintaining stability even in uncertain environments. Communication is another essential component. Effective communication from governments, central banks, and institutions helps guide expectations during both expansions and downturns. Clear communication reduces uncertainty, supports confidence, and aligns behavior with policy objectives. Poor communication creates confusion, increases volatility, and weakens policy effectiveness. In an environment where perception influences action, communication becomes a structural force in itself. Resilience, the ability to absorb shocks and recover quickly, is the cumulative result of all these elements. It emerges from strong institutions, prudent financial behavior, diversified economies, robust safety nets, and forward-looking strategies. Resilience allows economies to endure downturns without long-lasting damage. It supports stable long-term growth, protects vulnerable populations, and maintains social cohesion. The stronger the resilience, the less severe the impact of cycles. Resilience is not simply a defensive characteristic, it enables opportunity. Economies that can withstand shocks position themselves to take advantage of global shifts. They attract investment, retain talent, and develop new industries. They maintain flexibility to pivot toward emerging technologies or markets. Resilience transforms uncertainty from a threat into a source of strategic advantage. One of the deepest insights in understanding economic behavior is that progress depends not on eliminating cycles but on navigating them wisely. Cycles are intrinsic to human behavior and economic systems. They reflect the natural movement between optimism and caution, expansion and consolidation, innovation and correction. The goal is not to avoid cycles but to align short-term decisions with long-term logic. This alignment reduces the emotional extremes that often amplify volatility. When society understands this, it becomes easier to maintain perspective during both booms and downturns. During expansions, discipline prevents excess. During downturns, confidence prevents despair. Long-term strategy becomes more stable because it is not disrupted by temporary fluctuations. Individuals, businesses, and governments act with greater clarity, reducing the likelihood of costly mistakes. Economic behavior ultimately mirrors patterns of human behavior at scale. Just as individuals cycle through periods of ambition and reflection, societies cycle through growth and correction. The challenge is not to resist these movements but to integrate them into a coherent understanding of long-term development. When the logic of cycles, incentives, and structural forces becomes clear, the economy appears less chaotic and more intelligible. In this clarity, better decisions emerge, investments become more prudent, policies become more balanced, businesses become more resilient, households become more secure. The entire system becomes stronger because its participants act with intention rather than reaction. The long arc of economic development is shaped by choices made by millions of individuals responding to incentives, by institutions guided by memory and foresight, and by societies learning continuously from past experiences. When these choices align with the logic of cycles and the structure of long-term trends, progress accelerates. When they conflict with that logic, instability grows. By understanding these interactions, one gains the ability not only to interpret economic signals but to act with strategic confidence even in the face of uncertainty. Over time, this understanding becomes a powerful tool, one that shapes decisions, protects stability, and builds a foundation for enduring prosperity. Thank you for taking the time to explore these ideas with depth and clarity.